Hello, I want to welcome everyone to another episode of the Quorum Forum. My name is Kelly Milligan. I'm a managing partner at Quorum Private Wealth. I'm here with my partner, Mike Berry, also a managing partner at Quorum. And we're going to talk today about the recent volatility that we've seen in markets. So, Mike, it's been a while since we've seen this kind of volatility. How are you reacting to this?
Well, it's something that actually I've been expecting for a while. We just come off 2 full years, 23 and 24, where we had above normal returns in the overall market, in excess of 20% in each of those years. And one of the things that was unique about that, it was in a very concentrated sector of the market, particularly in a specific number of tech stocks surrounding areas such as AI and chips. And because of that, there was a extraordinary amount of growth that had happened in one sector, while at the same time, many other sectors of the market were being overlooked. And so most of that concentration of value and return was set up in a very vulnerable way that eventually it could correct. And I think that's what we're seeing now.
So if you had to describe what the main driver of volatility has been this year, what would you say that is?
Well, I think if you look at it from two angles, the main driver of what drove the market up was this certainty about what was going to happen with artificial intelligence and where this was going to go. So companies like NVIDIA and Microsoft, Meta, and a lot of these companies are going to benefit very much from the growth of this industry and this new way that we, go about our lives on a regular basis, which I truly believe is going to happen. And I think is a very innovative thing that's going to change our entire economy, that there was this real certainty that it was going to be coming from these companies. And there's been a lot of euphoria and enthusiasm for these stocks, and many of them saw real excessive returns in them. What's happening now is because of new iterations of AI that are coming out of China and other parts of the world, and it's thrown some uncertainty in the market, and uncertainty, I think, is the operative here, that maybe these companies in particular may not be the only players in the game, or may not be the only driving force with this going forward, and how that plays out. We've also had an issue with uncertainty that's coming from Washington, which is one where, if you haven't been watching the news cycle, there is the impact of potential tariffs that are going to be putting on our major trading partners from around the world, which is sparking fears of inflation, possibly recession, trade wars, and things like that, which may be throwing what's been a very vibrant, healthy, fast-growing economy, kind of off the rails, and push that out. So it's uncertainty that's really making this change, and it's being reflected in stock prices.
Well, let's unpack some of the elements of uncertainty that you mentioned. Let's start with tariffs, because that's headline news. Seems that every day you hear a different iteration of policy with respect to tariffs. How do you think investors and companies should react to the inconsistent messages that they're getting on how this is going to actually unfold?
Well, I think that's the biggest issue. It's inconsistent. So that's it. That adds to the uncertainty. So if you're going to be dealing with a 25% tariff, how you adjust your business around that, and how a consumer adjusts around that, and how an importer exporter adjusts their world around that as well, or how the currency adjusts around that. Until you know what it is, it's really hard to do. And there's nothing worse for the equity markets than uncertainty, because you're basically placing a bet on the future valuation of a company. It's not really based what you think that stock's going to be worth today. It's really reflective of what is perceived to be happening in the future. So until that gets nailed down, and whether the administration is currently trying to feel the water and play this out, and really use it as a tool to get to something that they specifically really do want. Maybe it's not a 25% tariff, maybe it's a 10% tariff. Maybe it's creating a whole new trade agreement between some of these countries with no tariffs. We don't know. But I do know that in the previous time that Trump was in office, he did impose tariffs. It actually didn't affect the markets for a long period of time. Companies adjusted around it, economies adjusted around it. I think that will happen again. But until it's nailed down and we know exactly what that's going to be, I think it's going to keep volatility moving.
Well, I think that's really the trick, is not only what is the tariff policy, but what is the definition permanence of that tariff policy? If it's really meant to be something that is a revenue generator over a long period of time, or is it something that is a temporary negotiating tactic?
Absolutely. Right.
It-
And so, I mean, think about many of these countries that this is going on with have tariffs on our goods when they come in their countries. We don't always impose it on them. Whether that's fair or not, I don't know. The world seemed to work pretty well prior to this, and it was very profitable. Um, the bottom line is when it's all said and done, does it benefit us for the long term? Does it make the U.S. from a GDP standpoint, profitability standpoint, and everything, a better economic outcome? And if you think about one of the main drivers of what's trying to be accomplished here in the America First idea, it's trying to drive manufacturing and the industrial base back into our mainland. So if you're going to sell cars in the US, you better build those cars in the US and employ people here in the US to do it. So I think this is kind of like a way to work a workaround to try to force that issue in order to avoid these tariffs and make it a lot more economically feasible way about it. But I think we're all going to suffer in the meantime until they get that nailed down and really figure out the solution.
Yeah. A lot of concern over tariffs gets back to worries about inflation. Tariffs are essentially an additional cost imposed on goods. Who bears that cost? Well, initially it's borne by the importer, but does it get shifted to partly to the exporter, partly to the consumer? That's the big question. But inflation was a big campaign topic. Inflation was front and center, certainly during COVID, when we saw inflation rates, 9% plus. Inflation has since come down to sub 3%, not quite to the Fed level of 2% that the Fed's trying to achieve, but it's come down a lot. But, it's still in the headlines. Look at egg prices. So how do you think investors should be thinking about, tariffs, changes in the labor market, mass deportations, price adjustments? How should they be thinking about that with respect to inflation and what inflation is likely to do in the future?
Yeah, tariffs, as you're saying, they are like an additional tax on something, right? Because you're paying the extra cost. And it's not unique to this administration. If you look back at the previous administration, Chinese were working on importing masses of a very cheap electric automobile. The last administration imposed a 100% tariff on that automobile if they were to try to do that, which basically made it, blew up any profitability of them for them to try to do it, because it wasn't a fair competitive market for them to do it. We survived it. We moved forward, and that happened. But I do think that there is a risk near term, until the economy adjusts around it, that this will increase some costs. Without a doubt, there's inflationary price thing can go on that. As far as employment is concerned, at first, you're seeing some major changes coming out of DOGE, which is going to possibly disrupt a lot of jobs coming out of Washington. Change
Certainly
that
in every agency of the federal government.
And if you're changing immigration in a radical way, I mean, if you want to build your industrial base and you want to reinvigorate your manufacturing base, you better have workers. You need to bring people in. So whether you fix your naturalization system and bring them in and everything else, as long as you're net importers of immigrants that are there ready to work and capable and have the skills to be able to do it, that should be, first and foremost, one of the most important parts of the immigration solution. the costs that could be that you can end up bearing if these tariffs actually are put in place, you could see costs be impacted, in the short end, as a result of it, over time, as it drives more manufacturing, industrial, more industry, more manufacturing here in the U.S. That over time will reduce prices, but you're not going to get it all at once.
Yeah.
Right.
So we just got a reading on inflation this morning. This is being recorded on March 12th. That was actually lower than expected. So that's a trend in the right direction. Unemployment is still below 5%. So arguably
very healthy.
kind of at the at a very healthy rate. What do you think the Fed is going to do with all of
the Fed? Yeah, the Fed doesn't like to play politics. The president, this current administration would very much like to see Powell lower rates, just like the previous administration. Last year, I think they were estimating 9 to 12 Fed rate cuts. They ended up getting a couple. And I think that was very disappointing, the last administration, but the economy was still really hot and inflation numbers were up and employment numbers were great.
And
in this instance,
over the course of 2024, the Fed did lower rates a total of 1%.
Yeah.
Even with a very healthy economy.
Exactly. So, and they did that, I think, just because they felt maybe they had overshot. If you look at the yield curve, which basically just measures what rates are from the overnight to the 1 year going out all the way to 30 years, there's actually a dip on the very short end of it, and then it steepens gradually going out. It was actually, for the most part, a very healthy curve, except for on the very short end. I think the bond market is telling us up front, we're going to see a couple rate cuts coming up here at some point, and maybe this sell-off in the market, maybe some of the disruption that's going to be coming with these tariffs and whatnot is going to, perhaps forecast that, hey, we're going to have a recession or at least a slowdown, in our economy, and that the Fed may pre-accommodate and start lowering rates. And if they do, and that falls in line in the yield curve, it actually would predict typically a very strong economy, strong markets, and a good opportunity to be able to go out longer term and buy bonds and invest. It's usually a very good environment if it works out that way. And I would think that's probably going to happen. I think that's what the yield curve in the bond market is telling us, that it looks a little scary right now, uncertain, but a couple Fed rate cuts and a few adjustments, we get rid of the uncertainty of what is being going to happen to us here. We move beyond that, we should be back on track with the economy pretty quick.
Well, the Fed fund futures market right now is pricing in 3 quarter-point rate cuts this year. And the side effects of that I can think of that would be beneficial are, number one, the government now pays over 7% of GDP just to service the debt. So if you start to lower rates, that debt becomes cheaper if the rest of the bond market adjusts accordingly. Lowering rates could also unlock a lot of real estate transactions. There are a whole bunch of people stuck in their homes at 3% mortgages because they know they'll never get that mortgage again. Well, if you bring rates a little bit lower, then maybe they can start to say, okay, mortgages at now lowered rates, I could absorb. And then we also haven't seen a whole lot of activity in IPO and M&A markets. We've been waiting for that for 2.5 years now.
Or more, yeah.
The main driver of that is rates, high rates. So you can unlock a lot of stuff with lower rates.
And not even just lower rates, but with the healthy yield curve, which we haven't had for over 3 years. And so I look at that as a very positive thing. And if you look at just the markets right now, as far as volatility, a lot of it is in the large cap, high tech, growth stocks associated with AI, so on and so forth, that we were talking about earlier. A lot of the rest of the market's been ignored and actually is trading at a pretty reasonable rate. You see something like that happen, and financial stocks, which is a really large part of the market, start behaving very well. You see other sectors that are also sensitive to interest rates start behaving better, such as utilities and other companies. And the capital market should open up, like you say, for IPO activity. So we think a lot of that will be a big driver going forward. And a big part of that cost of servicing our debt across the board would come down as well. And what's an important thing to think about with all the noise out there about everything else, whether they're right, wrong, or indifferent, we're sitting on a national deficit of over $36 trillion. There's two ways out of that. We either tax people to the point that we can use that money and pay down that deficit. And I'd like to see an example of when we've been able to do that as a country without politicians taking that money and spending it elsewhere. So I don't believe that's the way out. The other way out is to drive your GDP higher. How do you do that? You increase your industrial base, your manufacturing base, and expand the growth of your economy. If we do that, we can grow GDP above the amount of national debt we have, and that actually solves the entire issue. Because for one of the first time since World War II, we've had a few other instances where this has happened, our GDP is less than our national debt. And just like going to get a car loan, if your income and debt are out of whack of where you are, you're not going to get the loan. The US has been very fortunate for the last several years where we're, of all the other countries that you would feel secure enough in buying their debt, we're like the cleanest dirty shirt in the closet. And it's one of the last go-to places where you would buy. You're not going to buy Russia bonds or China bonds, or Europe's been a mess. You're not going to buy bonds in South America. Where are you going to buy them? You're buying them here. But traditionally you wouldn't, just because our GDP is less than our debt. We fix that. I really think that solves a huge issue for us going forward. And if any of these policies work towards that, expanding our GDP again, reinvigorating our manufacturing and industrial base, that's the fastest way to do it.
So that's a good future state, but until we get there, I think we're going to be watching inflation numbers. We're going to be watching job numbers. We're going to be watching what the Fed does. And I think you and I both agree that we're going to be seeing elevated levels of volatility and uncertainty in the near term. So what do you think is the prescription here? What should investors do right now in the face of what we think will be an environment of higher volatility and more uncertainty?
I think the experience that our clients already realize with us is that we're allocators. We're not chasing the market. We, over the last several years, if they can recall, that we've called them and said, "Hey, we got to buy all these AI stocks and chase them because they're going up every day." They're not going to remember that happening because it didn't. They're going to know that we do have some growth, but we have a lot of value. We have small cap, mid caps, all the other sectors in the market that actually have been being ignored and actually have been, for the most part, flat to moving up recently. As money has come out of the high growth sector, it's moving into those other underloved sectors. So it's actually been a plus in some cases for our clients. We also have had a good exposure to bonds, which is a safe haven and a good place to be in markets like this. And even more importantly is our exposure to some alternatives where we're in non-correlated investments that don't really pay attention to what's going on in the public markets. Spread out amongst all those things, the bottom line is we're diversified. We take an institutional approach. And as a result of that, you might see a lot of volatility in the headlines. You might see a lot of volatility, coming out of the news cycle and hearing about it from other people that were over concentrated in one area. For the most part, I don't think our clients will feel it much more than anything else. And just like in 2022, when the markets were down 25%, they didn't feel the full brunt of that. Even in years when the markets were up 23 or 24%, they experienced a lot of the good benefit of that, but didn't have all the volatility on the way up. I would stay the course. Don't steer away or let emotions drive what you do.
I think we've long held the philosophy that in the face of uncertainty, diversification is your first line of defense. I would say your second line of defense is to stay focused on your goals, right? Every client we work with, Mike, we put together a pretty robust financial plan, and we want to understand what you're trying to make your money do and how the resources that you have align with those goals. And I always like to refer clients back to the plan. Yes, we've experienced some volatility. Markets have moved one way or another. Has it derailed your goals? And more often than not, the answer is a resounding no. You're still on track. You still, are focused on what you want to achieve with this money.
Right. Well, and clients are looking for a certain cash flow from their portfolios. The amount of income it drives to them that they can use outside and keep their portfolio intact. You can have all the volatility you want. Your cash flow doesn't change.
Right.
So that's
And
still
dividends
there.
still keep coming in.
And there's a reason we do that. We do that specifically for that reason, that you basically get paid to wait for things to, correct the other way and go back to normal.
Well, so I think to sum it up here, my advice, maybe you agree with this, Mike, is don't sweat the short-term headlines. Markets always experience volatility. Don't let it drive your blood pressure up. And what was Marianne Bartels' quote on the frequency of corrections in the market? It's that during the course of a year, it is average, it is typical for markets to experience at least 2 5% drops and 1 10% drop. That's a typical year in the market. And we've gone through a couple of years now where I don't think we've touched 10% at any time over the last 2 years.
Barely 5.
So this is typical. This is normal. It is going to be a period of uncertainty and volatility, but this is why you have already prepared with the diversification that we set in your portfolio.
Right, exactly. And again, as you just mentioned, we expect it to happen. It's actually more frightening to me when it doesn't happen.
Yeah.
And it creates opportunity, and it kind of automatically rebalances what's going on in the markets and in the economy. And it's a bit of a reset, and it's really, really healthy for the investment market to go through this.
Well, it brings new capital in for sure.
Absolutely. Yeah,
well,
for sure.
We'll leave it there, but as always, do not hesitate to reach out to us here at Quorum if you have questions about your portfolio, about diversification, about any of the uncertainty that we've discussed here and how it might affect you. We thank you for tuning in and look forward to seeing you all on another episode of the Quorum Forum. Bye for now.
Goodbye.